Well, folks, in this next piece, we got to talk about this T.S. Lombard argument that how is this cycle different? And every time we hear this time is different, we want to be nervous. But what they're actually saying is tech. That's the only thing that's different about this cycle. What they discuss is this argument that this cycle is different because in every down cycle, there is a poster child for what got overbuilt, distorted, and basically bubbled up. And this time, T.S. Lombard argues it's tech's turn. It happens every cycle. An industry convincing themselves and investors that they are a growth industry immune to economic cycles, and then discovering they are, after all, a cyclical business, which means you are affected by the business cycle after all. Commercial real estate here is potentially another obvious problem and a coming issue for banks, given that banks hold 50% of commercial mortgages, specifically the smaller ones relative to the smallers. The larger banks hold about 7% commercial mortgages. It's the smalls and medium-sized banks that have more of exposure here. As far as inflation, high prices as opposed to the rate of change needed to reverse some of the items for consumers to gain lost spending power, blah, blah, blah. Okay, if not, so let's make this clear. As for inflation, high price levels, as opposed to the rate of change, need to reverse for some items for consumers to regain lost spending power. In other words, what they're saying is this time, in this recession, tech is potentially most exposed to a tech crush. Now, it could be argued that that's already happened, but they're saying that even if inflation goes away, prices are now so much higher, right? Remember, if you paid $100 for a piece of tech that now costs $120, you have experienced 20% inflation over a certain period of time, be that 1 year, 2 years, 6 months, whatever. And if inflation now goes away, you're still at $120. You have a 0% rate of inflation, but you're still paying more money. What does that mean? That means individual people have had their purchasing power, their pricing power reduced. And in order to regain pricing power, you might need to see wages go up. However, we're not seeing wages go up in the form of, say, a wage price spiral. And if we are not seeing wages go up and prices are higher, then people can simply afford less stuff. Now, an argument is being made that today we have plenty of excess savings still. Yes, it is true that not only do we have a lower savings rate now than we did before the pandemic, that is true, but we have a higher base of savings. Remember what Bank of America told us last month. Somebody with $5,000 in their bank account before the the pandemic now sits somewhere at $12,900 to $13,900 of extra cash. But what happens when that is spent? Are we in a deep, dark recession? Or have we finally conquered inflation? Jerome Powell's done with his rate hikes, and we can go back to the glorious bull run of the 2010 to 2019 cycle. Some people say that's delusional. Other people say, no, that's actually entirely what could happen. But let's see what T.S. Lombard argues. The coming reversal in credit expectations will also help lower inflation by pulling down service price inflation. So, in other words, less credit, less service inflation, great. But what they see coming will be a downturn with a recession that ends up correcting the excesses of 2010 to 2019, specifically tech and asset values, not simply a correction of the post COVID boom. Now, this is fascinating because this is actually a Peter Schiffian argument. Peter Schiff has argued that we are not going through a crash of the COVID money printing. We are actually repaying the debts of the bubble we created post 2008. T.S. Lombard is now echoing the Peter Schiffian argument. And folks, that is one that should create nervousness. Now, how could asset values go down? Well, let me make this argument in regards to real estate. So, a lot of people, obviously, you know this already. Well, most of you do, but some people don't. Obviously, for those of you who don't, I'll explain. I'm a licensed financial advisor, but I started in real estate. That's very rare. It's very rare that you have somebody go from real estate brokering to financial advising. This video isn't personalized financial advice because, of course, I don't know you. But when I look at this, I think I try to look at what's going on in the economy from both sides. I try to do the same thing in politics as well. It's very difficult because obviously divisive videos do much better. But what I think is fascinating is this potential that real estate may not necessarily rebound immediately if rates drop. We have this expectation that the bull run of real estate will continue if interest rates drop. But what might also happen if interest rates drop? The people who have refused to sell might think, oh, well, interest rates are lower now. Now is a good time for me to move and sell my property. Or maybe I'll get a higher price because interest rates are lower. But if everybody thinks that, inventory bubbles up. And you could actually then have substantially more inventory than you previously had in the last 8 years, frankly, certainly during the pandemic. And if you have to adjust to a higher level of inventory, then it doesn't matter if rates go down. You could actually see a real estate crush. And you could see that same real estate crush in residential, which could just be amplified by a similar crush that you see in commercial real estate. So I think patience in real estate is very prudent right now. Don't get me wrong. My goal with my real estate startup is to create a 10 to 100 billion dollar company with House Hack. I could not be more enthused about the path and trajectory we're on. So I'm very excited about that. But I am also having to be very cognizant of where are the potential black swans individuals aren't paying attention to. So I run those scenarios through my head. And this T.S. Lombard piece evokes some of those potential fears. Now, that's not to say it's, oh, FUD, fear, uncertainty, doubt. This is a real argument. So, as Daniel here says in the chat, patience is a virtue. I completely agree. And maybe it could be considered a normalization, right? All right. So, there's a little bit of a preview they give here on jobs, but we've already gone through the jobs data, mostly at expectations here. Now, I think this is very interesting. They show a confirmed weakness in white collar hiring, and they use this to basically say, while the tech sector is far from being relative to the entire economy, remember, you could lay off the entire Silicon Valley Bay Area and only affect 3% of jobs. So while the tech area is far from being relative to the entire economy, it has been on the margin an important driver of overall growth, hiring, and spending, and a source of income from the financial sector as well as investment wealth. When the tech sector booms, you have people who build their wealth, and when people build their wealth, what happens? People can spend more on services or going on a holiday, going on vacation, right? Tech employment increases 60% since 2009. Look at that difference. That actually gives you a showing here. Look at this. Two things here. Non-public tech firms net worth versus non-financial corporate tech x real estate. So non-financial corp. This is a little bit confusing. Let's look at this chart instead. I'm not going to try to understand that one here live. We'll understand this one together. High tech versus the private sector, excluding leisure and hospitality and social services. So that would be private sector jobs could be like manufacturing, PC repair, to some extent, that could be really any local business that is outside of tech. And what you're finding is this large wedge here between 2009 and 2022, where you've seen a boom in hiring for tech relative to other sectors. Commercial real estate, an obvious problem, notably the leverage and large offices. Yeah, and we realize this already, that JP Morgan just mentioned the other day that we could be seeing a $350 to $400 billion hit from commercial mortgages. I was just talking to another financial advisor yesterday, and they see they see BlackRock liquidating a substantial amount of mortgage-backed securities, and the liquidation of that could lead to the selling of a substantial amount of real estate assets. We shall see. Commercial real estate debt has been less of a problem than it was in the 90s commercial real estate recession over here. So you have less of a problem out here in terms of commercial mortgages outstanding in total. And then you could see that commercial real estate held by banks has been slightly trending up versus non-banks. The large banks have been heavily moving into commercial real estate, whereas the non-large bank lenders have been helping people with 30-year fixed rate mortgages. These are going to be your mortgage brokers, your direct lenders, your UWM, your Rocket Mortgage, and otherwise. Dollar's downward impact not finished yet. I actually believe that. I think that the dollar is likely to continue to fall, and that's why I started by taking a short position last summer in the dollar. And I'm not short the dollar right now anymore, but I do think there's still some move down, potentially in the dollar, specifically as yields fall. Remember, as yields fall, people's desirability or interest in the U.S. dollar declines. And that's because we need the dollar in order to buy quote unquote safe assets like treasuries. And so the more yields are high on our ultra safe, potentially the safest asset in the world products, the more we end up with a demand for our dollars, and that drives our dollar up. So now is take a listen over to CNBC. So we'll close off this section here. Let's do a summary, I suppose, on TS Lombard. I guess the summary here would be, is it possible that if we combine this summary, let's think about it this way. Combine this information from TS Lombard with what the International Monetary Fund said this morning, that we could be going into a 5-year slowdown. And what do you face? Well, you face an environment where potentially you could have a repayment recession of the bubble of 2009 to 2010's bull market. And you could have a 5-year slow blow recession with a real estate slowdown over the next 5 years. And in my opinion, the next 5 years, if we have a slower recovery and we do not simply resort back to the excesses of the 2010 to 2019 cycle, I believe the next 5 years would actually be a glorious opportunity to build your asset base. Think about it. What you want is your assets to be massive in the future. And if you potentially invested in, let's say, pricing power stocks today, which got us through the next 5 years, and then we went back into a bull run where credit started expanding again rather than tightening, and real estate really started recovering again, maybe you could set yourself up pretty well by working hard over the next 5 years and making sure you have as much available capital. Now, that's something we regularly talk about in the course member live streams, which I encourage you to check out. Link down below, you get lifetime access to those courses on building your wealth. And of course, you can use the coupon code that next expires, which means the price will be going up on the 12th of April, which is a week from today, when we will be covering, actually, it's not a week from today, it's actually only 5 days from today, when we will be covering the CPI release. And that's why we're creating the honor of the CPI coupon code, 69% off. Prices did tick up a little bit from the last time, and they will tick up again after this coupon expires. And you can now use Buy Now, Pay Later to join.